all for joining us this morning. As Matt said, this webinar is really to talk through the changes in the RNS that was announced last week. Obviously, one of the biggest changes, as Matt said in his introduction, is Nick stepping down from the full-time management of MIGO. We'd just like to reiterate Matt's sentiment. He's been a fantastic co-manager, and we wish him all the best. I am, however, delighted to introduce Tom Treanor, who will be co-managing the fund with me. Obviously, I've been working with Nick for 8 years now and been a co-manager on MIGO for 6. And I'm really excited for Tom to join the team and to take MIGO forward into sort of MIGO 2.0.
Thanks, Charlotte. So I've been at ADI for almost 15 years and spent my entire career, for better or worse, involved in closed-end funds in some form or another. Very excited to be joining Charlotte at what I think is the most compelling opportunity set I can recall seeing for closed-end fund investing in my entire career to this point. We have record-wide discount levels. But crucially, allied to that, we have a real uptick in corporate activity, which we want to be heavily involved in ourselves. So we'll just run through at a high level what the changes are to the portfolio. The main headline being, I suppose, greater conviction, and reflecting that greater conviction in a smaller number of portfolio holdings. MIGO today has around 40 holdings in the portfolio. We want to get that down over time. It won't be an overnight thing by any means, to between 10 and 15 core holdings. The reason for that being threefold, really. One, that if an idea pays off, we want that to move the needle in terms of impact on MIGO's NAV. 2, we think that the more bandwidth you have for each investment in the portfolio, the greater the research you can do and the more you can do to build conviction. And then allied to our intention to be even more engaged and more activist in the portfolio, a smaller number of holdings means larger percentage stakes in each and a bit more clout when you're dealing with boards and managers. Just on that point, we really want to build on what MIGO, what Charlotte and Nick have already been doing in the portfolio, but at an elevated level compared to previously perhaps. So engaging very actively with boards and managers to use our experience to find ways to narrow or substantially eliminate discounts to NAV. Again, really building on what's gone before, but more of a focus on event-driven investments. So it's all very well owning a closed-end fund at a wide discount to NAV, but what's going to change that rating on the fund? And that can be a focus on upcoming votes, perhaps. Look at the register, deciding based on that which way the vote is likely to go, looking for asset sales, particularly in private assets, that can drive a change in perception of the vehicle, and obviously, hopefully, have a tangible impact on NAV as well. And then finally, we're going to have, as reflecting the opportunity set in front of us, lower underlying equity exposure going forward and more of a focus on alternative assets. And that's really driven, as you'll see on the next slide that Charlotte will take you through, by the relative discounts in equity versus the alternative funds.
So as Tom mentioned it both in his introduction and just now, the opportunity set that we've seen in investment trust is one of the best that most of us have seen in our careers. And if you've been on a MIGO webinar before, this won't be news to you. This is something that we've been talking about for the last sort of 18 months, 2 years. Discounts have blown out to historically wide levels. This is due to a few reasons. Higher interest rates has sort of undermined quite a lot of the alternative side of investment trusts, OCF problems, and the consolidation of the wealth manager industry has also contributed to widening discounts. So, I mean, this is all stuff that we've talked about a lot, so I won't labour the point too much. But I think this slide really helps to show why we are moving away from owning too many sort of equity investment trusts and moving more into the alternative side, where we see the best discounts and the best opportunities. There's already been a considerable amount of activism already in equity trusts, and you can see that some of that has helped narrow the average discount in that sector. But we think there's an awful lot more to go for throughout the rest of the sectors in the trust world. So we'll be focusing more on things like property, renewables, private equity, growth equity, etc. And what is MIGO 2.0 going to look like? This is the top 25 holdings as of the 31st of March. Well, as you can see, we have a stage 1 in mind. We're obviously not going to release the holdings that we anticipate having, but you can see from the weights on the right-hand side that the portfolio becomes a bit punchier. We have more weights in the top holdings, and this will reflect our conviction in these names. We are not saying that we're not giving ourselves a strict timeline, because it will be, market dependent. But we would imagine that we would be here, 6 months down the line, and potentially even sooner, depending on, catalysts coming through. The final 2.0, the sort of 10 to 15 core holdings, and core is key here. We imagine will take somewhere between 6 to 12 months. And we would have a portfolio that we would anticipate looking like that final 2.0 on the right-hand side at around the year mark.
Just to expand a bit on the earlier key new theme of activism and engagement. So I suppose a key point to make here is that we engage with every investee company in some form or another. The key difference will be the intensity of that engagement. If you have a company where there's a clear event in place that will narrow that discount, the board's doing a good job, and looking after shareholders, then that engagement will naturally be a much more mild form. If whether we think that a board is not doing the right thing for shareholders, then that intensity will obviously be much, much greater. So what we're really trying to achieve is an outcome where we leave the company or the fund in a better place than it was when we found it, if you like. The actual topics themselves can span things from general corporate governance, capital allocation policy is absolutely key at the moment. If a fund's trading a very wide discount to NAV, it's almost always better to be buying back shares rather than making new investments in the portfolio. And then finally, and probably not spoken about enough, is the quality of boards. I think the quality of boards is a really key driver of outcomes for shareholders. There are some very good boards out there. There are some less good boards out there as well. And if we can play a role in improving board quality, it's something we're very happy to do that will benefit the wider sector as well, we believe.
So one of the things that we're very keen to impress on people is that we're not taking a machete to the current portfolio. This is not a fire sale. We're not just getting rid of current holdings because we want to move the portfolio over. What we're looking to do is to enhance shareholder returns at every single stage of the venture. So for holdings that we already have in MIGO, and obviously we've got 2 examples here, no names mentioned, but some longer term holdings in MIGO, what we'll do is from this increased activism engagement, we'll be using that to leveraging this to try and work with boards, work with management teams to narrow persistent and wide discounts. And you can see that there's a couple of examples here where we think that we can add real value, whether it's on capital allocation or working with other shareholders, that we think we can get the best returns for MIGO shareholders, and for us that's the most important thing. So we're certainly not there's certainly no fire sales, there's certainly no we're certainly not going to be turning over the portfolio overnight. We are going to work over the next months and years to really enhance shareholder returns for everyone.
This will take you briefly through a few examples of AVI's activism, which we've seen in the AVI Global Trust, where I've led the closed-end fund investments for the last 10 years or so. Rather high-profile one on the left was the Hypnosis Songs Fund. This was a classic case of what we would characterise as poor and poorly resourced management team, and unfortunately a rather weak board that failed to oversee the manager correctly on that. We did a huge amount of work to underwrite our estimated value for the portfolio and engage with the rest of the shareholder base. And that's actually a really, really key point about good activism, about activism at its very best, is working with the rest of the shareholder base to form a consensus to then collectively put pressure on boards to achieve a better outcome for shareholders. In a particular case here, we helped remove a large portion of the incumbent board and replaced them with two or three in the end, extremely high quality directors. And the outcome there was that the fund went from trading at a very deep discount to NAV to the new directors engineering a sale to Blackstone at a very substantial premium to where the share price had been languishing before that. There's more examples here that I won't take you through in detail, but I think the key point to note is that the latter two were entirely private engagements, and that our default position is we always want to start off engaging in private. I'm very happy if it ends that way as well. But the fact that we have gone public in the past and things that we have the experience and know how to do that, we think tends to lead to better outcomes in private. And so very often we don't need to engage publicly.
So we've taken you through the portfolio changes, how we're looking at managing MIGO, and now we'll take you through the three corporate changes that we've also put in place. We've already talked about Tom joining the team as co-manager and Nick stepping down. Nick does remain an employee of AVI, and he will be around in a consultancy capacity, offering his wisdom and his experience. What we have done, and I think it's important to really pull out the fact that what we're trying to do with some of these corporate changes is really make MIGO the best in class for corporate governance. We want to be as aligned with shareholders as possible, and to ensure that everything that we have in terms of these corporate changes aligns ourselves with best practices, we're aligned with shareholders, and we're looking at returns rather than asset gathering. So first of all, on the team, as I mentioned, Nick is stepping down, but we also do have under AVI, and obviously MIGO moved over to AVI 18 months ago, but MIGO has already benefited and will continue to benefit from a much wider investment team. We have 11 members of the investment team, with two particularly pulled out here that have particularly worked on the trust in some capacity. Scott is a property specialist, and that's been very important over the past year, but we've seen a considerable amount of movement in the property sector. And Ross is our analyst, and there's nothing that he doesn't know about Treanor. And as Chrysalis is one of our biggest investments, that is enormously helpful. So Tom is going to take us through why and how we see the SEF market, and why we think that the corporate changes lends itself to how we see what the closed-ended fund market going forward.
Thanks, Charlotte. So many of you on this call will be aware of the seemingly relentless consolidation of the wealth management industry. Wealth managers being for a long time the natural buyer of the London-listed closed-end funds, the investment trust market. The problem the problem the sector faces is that the larger wealth managers get, the larger their minimum tickets become, and the more funds are off limits to them. And what we're seeing as a result of that is more and more demand for larger vehicles. And what we see, the way we see this sector shaping up or shaping out in the end, is you have very much a bifurcated market where the larger, more liquid funds have merged together to create real scale that the larger wealth managers can then purchase and exit from much more easily. And then when we think MIGO fits in, we think smaller specialist funds that have a reason to exist because they're making full use of the closed-end structure. In terms of why the closed-end fund structure works, it works really well for more concentrated portfolios, for less liquid portfolios. And that's certainly what we anticipate MIGO's portfolio looking like. We intend to carry on using gearing as well. And we strongly believe that we are giving investors access to a very differentiated, niche and inefficient part of the market, where opportunities for generating alpha are very, very large. So the market itself, as I touched upon there, we believe is an inefficient market at the best of times. We would say right now it's particularly so. There are simply far too many funds in the market. We had a issuance boom for 15 years of all different shapes and sizes of alternative income vehicles. We're now what we see as the great unwind phase. We can see the sector shrink and have already started seeing that through take privates, through mergers, through managed runoffs. And all of that gives the opportunity for great returns for a specialist investor like us. However, what we would say is that the market in closed-end funds, to properly exploit it, you have to accept that it is very much capacity constrained.
Which moves nicely on to the two biggest corporate changes, which is the capital redemption mechanism and the management fee structure. So the capital redemption mechanism, it seems a little at odds with what's going on with the rest of the market. As Tom mentioned, investors are looking for ever increasingly bigger and bigger funds. But we believe that keeping MIGO's NAV below 150 million is the best way to create returns for shareholders. And as we keep saying, that is our main goal. So we've decided to put in a capital redemption mechanism. This is at the director's discretion. But it does mean that MIGO is able to exploit the entire opportunity set in the closed-end fund network, so that we can go all the way up and down the market cap spectrum and find the very best ideas. It also means that when we take these bigger positions, that they have a meaningful impact on performance, and it also provides liquidity for investors. We will continue to have our 3-year realization opportunity, but once the MIGO goes substantially over 150 million and capital is returned to investors, that also provides another opportunity for liquidity. And the management fee structure, and we've talked about this earlier, is really incentivizing performance rather than just gathering assets. We don't want to be rewarded for poor performance or lackluster performance. We want to be rewarded for the returns we create for shareholders. So we have nearly halved our base fee to 35 bips on the lower of market cap or NAV. And then we have a performance fee of 15% in excess of SONIA plus 3. So our benchmark is SONIA plus 2. So we put in a performance fee of SONIA plus 3, so that we're not just beating our benchmark. What we're looking to do is to go above and beyond the benchmark, and that's when that performance fee will kick in. We have put a cap of fees on 2.5% of either the lower of the market cap or NAV, and 25% of these performance fees are reinvested in shares. And what we hope between this capital redemption mechanism and this management fee structure is it creates MIGO and means that MIGO is a best in class in the investment trust world of doing what's right by shareholders. So just to do a quick summary before questions, the 3 sort of big changes can be summarised into those 3 categories. Firstly, our management team. We've evolved the investment process, and I think evolved is the key word to pull out here. This is an evolution, not a revolution. When MIGO was launched in 2004, it was much more of a generalist fund of funds, and it's the mandate post 2008, 2009 to look at those discount opportunities evolved from where the market was at that time. And we're just seeing, we're seeing what we're doing currently as being another evolution in that investment process. We're still looking for discount opportunities, but we're just evolving how we do it. And finally, our new aligned fee structure, which we believe aligns us as well as it can do with shareholders.
Brilliant. Thank you both very much. We've already had a huge amount of questions, so we'll get stuck into those. But just a reminder, for anyone that would like to add a question, please use the Q&A function at the bottom of your screens. To start things off, will every investment be an active one?
Short answer is no. So what we're really trying to do here is to build on what Nick and Charlotte have already been doing and use the benefits of mine and the broader AVI experience in activism to really give another lever to generate returns to shareholders. So we're not a hammer looking for a nail. You know, there'll be certain cases, there'll be many cases where activism is not the right way to achieve returns. It's really just having another tool in our toolkit.
Brilliant, thank you. Will MIGO continue to keep tight discount control if holding more asset classes that are less liquid?
Yes. So one of the things that was very important to us was to continue to keep our discount narrow. It's gone a little wider than we would like at the moment, but we will continue to take out overhangs in the market in order to keep that discount tight. We still think that investors should enjoy the discounts in the portfolio rather than facing discount risk at MIGO's trust level.
I think just a point to add to that as well, Matt, is that although the underlying asset classes are going to be more in private assets and are themselves much less liquid, the actual wrapper in which they're housed, the investment trust they're in, won't necessarily be any less liquid than the original MIGO, if you like.
Yeah, makes a lot of sense. Does the future indicated equity weight include private equity, or is PE no longer a target asset class going forward?
Private equity is certainly something that we anticipate having exposure to. You have extremely wide discounts there. You have more and more funds buying back stock, and many directors and many boards of these companies accept that they have a real challenge on their hands there, and we anticipate corporate activity picking up in that sector. And you should expect, all else equal, the listed PE to form a key part of the MIGO portfolio going forward.
There's a few questions around how AVI will support MIGO. So I don't know whether you can touch on that, and maybe how do you see MIGO's positioning? How do you see MIGO's positions interacting with other AVI mandates? Might additional firepower be utilised to drive change?
Yeah, so this is obviously a question that we've had a lot since MIGO moved over to AVI. MIGO, is a separate vehicle. There's absolutely no plan to merge it in with AGT. We think it's a distinct and interesting offering, and it remains its own trust. We do have some overlaps in the portfolio. So Chrysalis would be a good example that's held in AGT and in MIGO. These were bought independently. MIGO purchased Chrysalis before we joined AVI. But it's quite clear that MIGO enjoys the benefits of AVI Global's big shareholding in Chrysalis, as it does give you, more firepower when you're looking to do some of that engagement and activism. So I think we've always described it as that it's collaborative and collegiate, but MIGO is very much, looking for our own investments and on our own portfolio.
Great. And on the front of activism, people have mentioned that this is very similar to the likes of Achilles. It's clearly early days, but where do you see the distinction between MIGO and Achilles?
Look, so we know the guys at Achilles very well and rate them very highly. I think there's certainly room for more activists in the market. The opportunity set, as we saw on an earlier slide, is around £20 billion in terms of trapped discounts, if you like. So the more the merrier, I would say there. I don't really want to get too much into comparing ourselves to other vehicles out there, but in that particular example, probably the number of holdings would be a key differentiating point.
Yeah, absolutely. And maybe we can talk about MIGO's allocations going forward. Is this opportunistic, and when you can make decisions based on market dislocations that may occur further down the line?
Yeah, so nothing is set in stone. That's why we very much sort of put holding one, holding two. We haven't been too prescriptive about asset allocation, because it will be very much market dependent. It will be very much opportunity set dependent, opportunistic. So we're giving ourselves a good deal of room to maneuver the portfolio to whatever we see as the best opportunity set at the time. There will be a combination of different asset classes. There will still be diversification between asset classes. As we said, the biggest change is probably a lot less equity trusts, but otherwise, we're keeping a very open mind and just looking for the best discounts with the best catalysts.
Great, thanks, Charlotte. What is the longest timeline where you would intend for activism having an impact on individual positions?
If I interpret that as being how long would we give it before we give up, I suppose. And really, it would be a case-by-case basis, and we will be doing, and we do already, a lot of pre-investment research into what the engagement angles look like or will look like on a particular fund. So we're doing very intensive research there on the register. We're looking at the quality and character of the board as well. We're trying to work out a potential exit plan or sales market for the assets sometimes as well. So really, we want to position ourselves to a point where we have a very clear idea about what the time frame is going to actually be from first investment to getting our money back, if you like.
Yeah. Are there any plans to invest in overseas listed CEFs?
It's entirely possible. There are obviously other big closed-end fund markets out there, but our predominant focus and where the value is very much for now in the London market.
Yeah. Just talking about the portfolio again, MIGO's previously been known for investing in smaller cap ideas, believing that investors can access larger fund ideas themselves. Can we assume this is a restriction to smaller cap ideas going forward?
I don't think so, no. One of the reasons that we've said that we are capping MIGO at 150 million is so that we can invest down the entirety of the market cap spectrum. We don't believe that we've done the calculations, and we don't believe that the current redemption cap means that we can't invest further down the market cap spectrum. We still believe that it's usually the smaller trusts that are more difficult for other investors to access. Maybe are more overlooked and give us an opportunity to go in and engage and be more active. So no, it's certainly not. We certainly won't be kind of just investing in bigger trusts. The entire market cap spectrum will be open to us, and I would see that we would be more biased towards smaller and mid cap trusts.
In terms of speaking about the cap on MIGO at 150 million, does this mean it potentially limits or makes it harder to attract institutional money?
I think there's a certain, there is a potential for that. But I would argue that attracting institutional money is already incredibly difficult unless you are, well over 500 million market cap. Anyway, so I don't know that I think that, and at that point, MIGO would be, far too big to be able to effectively run money in our mandate. So, it is difficult, but we think that having a really differentiated offering is something that can be very attractive. Yes, smaller trusts are always going to struggle with the bigger institutional guys, but that doesn't mean that there won't be interest and there won't be some buyers.
And just to add a little bit to that as well, I suppose I'd say that the continuation of MIGO's robust buyback policy provides liquidity for those looking to exit, and a redemption facility at 150 would also provide some natural cash flows back to people. So perhaps in that sense, large institutions can gain a sense of reassurance that they will be able to exit the investment should they actually want to. we hope to get MIGO back to trading at NAV at a premium and issue stock as well. So if we can manage that, that should help institutions get some comfort that there's liquidity on the way in and also on the way out as well.
Brilliant. By capping MIGO's size, does that mean it will struggle to compete with activists who are taking big stakes?
I mean, that is part of the reason for limiting the number of holdings in the portfolio as well. I mean, you know, it's basic maths that the fewer holdings you have, the larger your percentage stakes in each of them as well. We also don't believe that if your investment thesis and investment case is good, that you necessarily need a massively large stake in a company as well. And again, back to my earlier point about speaking across the shareholder base, forming a consensus, we think that us, alongside other like-minded shareholders, are in a good position to effect change in companies.
Great, thank you. Do you expect MIGO to continue this more engaged or activist approach when the investment company market and discounts return to normal levels? And if so, why?
Yeah, I mean, I think that activism engagement, I mean, it's particularly pertinent at the moment because discounts are so wide, but we do believe that it's, you know, a massive value add, whether discounts are wide across sector or whether, you know, discounts are only wide in, you know, in a much smaller amount of funds. So we think that it's one of the great ways of extracting value and creating returns. So, you know, and I think what's important is to remember, obviously we've had the, you know, the big announcement and it feels very new, but it's always, engagement's always been something that, you know, MIGO's done to a certain degree. It's always been a tool in the toolbox. What we're doing is bringing it out a bit more, making it more front and center, and making it, you know, more of a day-to-day part of the fund. So this isn't something completely new for MIGO. And I think also it's worth remembering that this is something that AVI have been doing both in closed-ended funds and in, you know, in both in Japan and as well, throughout the cycle and throughout this and you know, throughout discounts being wide and narrow in the trust world. So you know, although it kind of might appear that we're sort of jumping on a bandwagon, what we're really doing is just pulling it out and making it, you know, a more, as I say, front and center of MIGO. But this is something that both myself and Nick and Tom have been doing for many years.
Great. How do you intend to balance ultimate returns against activism? Would you encourage boards selling assets at material discount to accelerate shareholder returns?
I think it depends on how valid the reported NAV is. I mean, you know, all NAVs are not created equal. Clearly, if we had bought into something, or rather a fund had been traded at a very persistent 50% discount for the last 3 or 4 years or so, I'm sure all shareholders would welcome an exit from there at, say, a 10 discount to NAV. So we don't think that NAV should be a line in the sand where there is ambiguity around what the assets are actually worth. So, but what we would be opposed to is anything that's very, very destructive. So anything being sold for less than fair value is clearly not something that we would welcome at all.
Right, thank you. Why would MIGO be able to trade at a premium when the likes of Pershing Square has bought plenty of a stock in and still trades at a large discount?
I could probably spend an hour on that, but I'll try and keep it to a minute or so. So Pershing Square is a very different vehicle from MIGO. Pershing historically had very poor discount control mechanisms. They were very late to starting to buy back stock. And I would argue that by that point, discount had become entrenched. You also have there a controlling shareholder in the form of Bill Ackman, who owns around a 25% stake in the company. And the fact that he has that blocking stake there means that the shares are always, in our view, likely to trade at some sort of discount. I suppose, sum it up by saying that it's a very different vehicle from MIGO.
Brilliant. And looking like we're coming towards the last couple of questions, do you think there'll be any hit to NAV during the transfer to the new structure? And I guess also maybe touch on, is there any concern of unwinding the share price of your current positions in illiquid holdings when selling them?
Yeah, I think this sort of comes back to what we were saying earlier about, we're not taking Machete to the portfolio. This is not a fire sale. We don't believe that there should be a hit to the NAV, because we're not prepared to sell things at prices that we don't think is fair. We prefer the move over to be slower but better, but we don't think that we certainly don't think that is the case, and we don't think that will come to fruition. We're prepared to sit and wait and create good exits from current portfolio holdings rather than necessarily just sell into the market at a knockdown price.
Yeah, makes a lot of sense. So that actually brings us to the end of our questions, but if I could hopefully just leave you with a very brief summary of what we can expect going forward. So MIGO is going to have a high conviction approach of between 10 to 15 core holdings that align with the current opportunities in the sector. There'll be more influential engagement with boards, which will aim to accelerate returns to shareholders, a reduced management fee with 25% of any performance fee paid as MIGO shares, and a NAV limited to 150 mil, so that MIGO remains nimble and is best to exploit the opportunity set. Hopefully you can agree that this is extremely exciting and timely change for MIGO. So Charlotte and Tom, I'd like to thank you for your time today, and also I'd like to thank everyone else for dialing into today's call. If you have any further questions or would like to arrange a one-to-one with the team, please email ir@frostro.com. But thank you very much, and we'll see you next time.
Thank you very much.